So where do stocks fit in a diversified portfolio? A portfolio being think of it as a basket of your holdings of your investments that you have, your various investments. Maybe you have some cash investments or bond investments, or you have precious metals like gold, silver, you have investments there, and investments in stocks. And within stocks, you have individual stocks or mutual funds or exchange trade funds, a lot of different variations, of course, on that. But your portfolio is basically your whole basket of all your holdings that you have as far as your investments. And so where do stocks fit in there, and how does that kind of relate to your risk tolerance? And a couple ways to look at it as far as building a portfolio. One is to think about how far away is your goal. If you're saving money, let's say, and you're investing money because next year you want to retire, let's say, for example, well, if you're buying stocks today that, a year from now you want to retire, that is a very, very risky move. See, stocks are, have a lot more volatility or risk, as in they go up and down frequently, actually every day, but sometimes they can have wide swinging periods of return. So stocks typically are looked at from a risk standpoint as far as a longer term investment. I've seen folks say like 3 years or more, or things of that nature as far as holding stocks. You might even want to be even going beyond that. But the idea of investing in stocks is long term, think long term, versus, let's say, investing in cash where you get very little return on your cash, but it's something you can get at real right away, and you're not expecting a great growth on it, but you're not expecting it to go down either. It's not going to go down 10% in a day like an individual stock may. So think about when you're building a portfolio, and where stocks fit in is how far away is your goal. The further away it is, the more stocks that you can have as far as a risk idea. Think about your risk tolerance, and there's various tools and things we'll look at online in the as far as different tools you can look at to determine your risk tolerance. But even without using a tool to figure out your risk tolerance, you kind of know in your gut a little bit, like, when stocks go up, yeah, everybody feels good about that, but how about when they go down? How if they go down 10, 20, 30%? What if your stocks went down 30% in 2 months? What would you do? Would you sell? Would you feel really uncomfortable about that? Or would you be enthused and want to buy more of the stock, thinking you're getting them on a bargain basement deal? So if stocks go down 20% and you look at it as, hey, what a great buying opportunity, I'm going to take some of my cash and buy more stock. Well, you're a very risk averse, or you're a very risk aggressive investor. You're like, I want to take on more risk to get more return. If it's down 20% and you feel queasy or very nervous about it, well, then you're more risk averse, and that's okay. Just the key things you want to understand is where you're at on risk tolerance. Stocks are more risky, and so the more stocks you have in your overall basket of investments, your portfolio, the more your overall portfolio will go up and down. Particularly that down part is how do you react when it goes down. So understand stocks are more for the long run and are more risky, and understand how that relates to your risk tolerance. Lastly, think about need too. When are you going to need the money? Well, that's how far away is your goal, but what is it looking to do for you? Are you looking to invest in maybe stocks for a long period of time where you want them to grow and grow faster than inflation and grow very well because you're not going to tap into it for 20 or 30 years? Well, then you can take on more stocks, or you can take on more aggressive growth stocks. Or maybe you're like a retiree right now. Let's say you're going to retire in a year, or you're going to retire and you have a lot of income producing things like cash or bonds, which are made to give you income. Maybe you want to supplement that with a few dividend type paying stocks or dividend mutual funds, things that pay out income that are dividends, but they get you a little bit more growth because there's still a stock, still more risky, but less risky than, let's say, a high-tech stock, for example. But it's a less risky stock that'll still pay you every quarter some money or income, and you have that be a small part of your overall portfolio or basket of your holdings. So think about how far away is your goal, how is your tolerance for risk, and then kind of what you're needing out of this. Are you needing growth? Are you needing income? Are you needing a combination? Do you need safety? In that case, you might be have very little invested in stocks. So those are three big things to consider to get you started with that. And the next lesson, we're going to look at some sample portfolios. Like, well, okay, this is nice, but do you got some ideas? Like, if I'm a moderate investor or aggressive investor, what might be some ideas of returns and some ideas of some basic portfolios, what percentage to put in stocks and what percentage to put in something else to just at least help me get me started, at least start thinking around that? Well, we do, and that's the next lesson. So let's look forward to that next lesson and learn about different ways that we can make up a portfolio with a variety of assets, including stocks.